Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Welcome to the Zacks Top Stock Picks of the Week. I'm Tracy Brynick, and this week I'm joined by Jeremy Mullen to discuss two Zacks number one ranked strong buy stocks that are also value stocks and are trading near their highs. Go figure, but value is the place to be, so we're bringing them to you this week. And my stock is Toll Brothers, ticker TOL. It's one of the nation's largest home builders. It's on the luxury side. And who's doing well right now? Well, the richer people. So they're doing great on housing right now, but all housing home builders are doing good because everybody wants something new. We're all out there buying with these record low mortgage rates. And it's just creating one of the hottest housing markets in about the last 15 years or so since the housing boom. But it's not a bubble. It's being driven by sound fundamentals. And Toll Brothers, as I'm about to show you, is really operating on all cylinders right now. It just reported its fiscal fourth quarter report and gave good guidance for first quarter and for the full coming year, because those millennials are out there buying homes, even on the luxury side. So let's dive right in and take a look at those earnings estimates because they're very high. Analysts have raised their earnings estimates for this new coming fiscal year off of their earnings report, which just happened last week. So they're bullish about this year, but also the following year, as you can see, is looking bullish as well. And you can really see the big jump up here from 883 to 952 here in this next fiscal year, and also another dollar or more for the next year after that. And you can really see, based on what they did last year here, 663, which was a great year for them, but expected to be up 43% here this year, and then another 18% next year. Now, the thing to watch with the home builders are gross margins. They just did 25.5% for the year. They're expecting 27.5% for next year. That's where you get the rising earnings because you get the expanding margins. Now, they are still paying the price for higher lumber costs that happened last spring when we had those record lumber prices. Those have come way down, but it takes over a year for that price to work its way through their home building and cost structure. So that will finally work its way through in the second half of this coming fiscal year. So that's when you're going to see much higher gross margins on those quarters. They did price in higher labor costs and the higher costs on the other inputs, which is like, appliances and windows and things like that are having some supply issues, and the prices are rising on those items. But that's all been priced in on their guidance. So it's still looking very hot, even with these inflationary pressures that they're expecting into this year. But they will get a little relief from the lumber prices in the second half of the year. What does their chart look like if these earnings are looking this good? This is what their earnings look like charted out. So the prior couple of years were strong, as you can see here. You got the big boost. This is a pandemic boost here, then really the big pandemic boost in the last fiscal year. But here we are starting off both of these 2 years, very strong growth coming off of, a couple of not so great years, good, but not so great. And now the pandemic and the demand for new homes with the low mortgage rates has really taken off here. And most analysts expect it to continue just because of the demographics of the millennials through at least 2024. So Toll Brothers still trading really cheap here, even though, as you can see here, it's now trading at a 20-year high. Still, the forward PE, because those earnings are rising, is only trading at 7.8 times. So under 10 times for Toll as the cycle really begins to pick up. Its PEG ratio is just 0.3. So that's also a value indicator. Anything under 1 for a PEG means you have both growth and value. So you're getting both things here with Toll, which is unusual in this market to get the cheap with the growth. But it is here, as I keep saying, because those millennial buyers. Now, year to date, these shares are up 68%. So, in a lot of people seeing this kind of chart and this kind of hotness and thinking, how much more can it have? But it can have much more. And I tell you to look at this rally here from about 2000. Well, this goes back to 2001 because this is a 20-year chart, but even from 2000. So the dot-coms busted, but the housing market never did. And then we started to see this growth here, and we got the all-time high, the previous one, during the housing bubble. But this is not a bubble here. This is fundamentals driving this market, and supply and demand, very low inventories, both on existing and new construction homes. So, and just too much demand. So while you're getting this record high in the price here, again, the valuations are quite low, and that is a powerful combination that tells you that this stock will most likely have more in the tank as we go forward here. So I believe we've entered a multi-year bull market in all these home builders. Toll Brothers is the largest on the luxury side, and luxury will hold up even if those mortgage rates start to rise. 20% of their buyers pay all cash. So they have a cushion there when those rates start to rise. So that's why I'm very bullish on Toll Brothers. I own it in my value investor portfolio, and we're holding it, obviously, because it's still a value. It's got that growth. It's got the Zacks #1 rank strong buy ranking. So it's got it all. And I encourage you to look at all the home builders right now, but this is my pick for this week's top stock picks. And I'm turning it over to Jeremy now, who also has a value play that's also trading near its highs, but it's not a home builder. So Jeremy, take it away.
Thanks, Tracy. And hello, everyone. I'm Jeremy Mullen here today with my top stock pick. Today, I will be doing Tyson Foods, ticker symbol TSN. Tyson is a Zacks ranked #1 strong buy that is, of course, a popular chicken company. Tyson produces, distributes, and markets chicken, but also deals in beef, pork, as well as prepared foods. The company recently beat on earnings, which helped the stock hit 2021 highs. Not only are earnings looking up, but the company has introduced a new productivity plan that could be a big positive for the stock in 2022. First, let's go over those earnings. Okay, here is the price and earnings surprise chart, which you can see earnings over the last couple of years. Tyson recently reported upside of 4.5% in November. Revenues also came in above expectations. They guided fiscal year 22 higher. The company bumped up their dividend slightly, and they see CapEx for next year at $2 billion. The healthy quarter comes despite higher commodity prices. I'm sure everybody's heard about the higher inflation that's also affecting food. So in order to fight that, Tyson is raising meat prices as their costs escalate. On the earnings call, the CEO commented that the worst of the labor shortfall was behind them. Their poultry plants are almost fully staffed as they head into the end of the year. As you might remember, the shutdowns from COVID, they had staffing issues that shut down some of their plants, but they're back up and running and almost fully staffed. This EPS beat was the 6th straight, and while the magnitude wasn't as high as the previous quarters, estimates are ticking higher into next year. But before we look into those numbers, let's talk about the company a little bit more. I want to bring up the profile page here. Tyson has 137,000 full-time employees. It's headquartered in Springdale, Arkansas, and was founded in 1935, so it's been around for a while. The company has a market cap of $30 billion, a little over, and has Zacks style scores of A in value, B in growth and momentum. Forward PE is just over 11, so there's a value play here, and the dividend is 2.2%. Now let's look at those estimates. Come down here and look at the magnitude here. Over the last 30 days, estimates are trending upwards. For the current quarter, we've seen the estimates go higher by 20% from 172 to 207. And for the current year, over that same time frame, we've seen a 5% move higher. Now, analysts are citing adjusted pricing and credit management for a job well done in this tough environment. And while earnings and estimates look good, the market is looking forward to some cost-saving efforts, which could help bottom line through 2024. So the goal of the company is to save money to improve on their bottom line. And the idea behind that is the $1 billion productivity program that beginning next year they'll be launching, and it will target $1 billion in savings by the end of 2024. Management says this program will be designed to drive better, faster, and more agile organization that is supported by a culture of continuous improvement for faster decision making. The impact should be felt next year as they are shooting for $300 to $400 million in savings for fiscal year 2022. So analysts are pricing that into these numbers going forward. Okay, that's pretty much it for the fundamentals. Let's look at the chart. Okay, here's the chart looking back about 10 years, and you can see we kind of broke out and traded higher over the bull run, and then we had the COVID crash. Now I have a Fibonacci retracement drawn from these lows to those highs, and look where we're kind of found support at the 61.8% Fibonacci retracement, and we've grinded higher. So what I do typically on these macro Fib retracements, I target the negative 23.6%. So that's what I'm looking for, a move over 100 to 110, perhaps sometime next year. Now let's zoom in a little bit and kind of look what might be coming in the shorter time frame. Since May, we had a summer pullback that the 200-day, the red line, held support. Since then, the blue line, which is the 50-day, has been a nice support level. However, it did break recently on the market sell-off, but the bulls took it right back. The green is momentum. That's a 21-day moving average, and that has held up a majority of the time, especially recently. Now, we did see the earnings bring it to not all-time highs, but highs that we haven't seen since earlier in the year. And we pulled back into this micro Fibonacci retracement, 61.8%, same kind of thing that I showed you on the macro chart. And we're back near those recent highs. So we're above the moving averages, which is healthy. We're near these recent post-earnings highs. And I think we can get back over these highs. We see 88 in the short term. So for short-term traders, they might want to look for this. For longer term, you might want to look for that move above 100 into 2022. And to summarize, Tyson has just proven itself in this tough environment, and stockholders have been rewarded, and it looks like they will continue to be rewarded. And if we do come off those highs again, investors should look for support levels, the 50-day, the 200-day to buy into, to take advantage of that cost savings productivity program into next year. Okay, that's it for me and my top stock pick. I hope you enjoyed.